Hi. Let's learn about buy-in for stocks, how share repurchases work. A buy-in refers to an occurrence in the financial markets when an investor is forced to repurchase shares of a security because the original seller did not deliver the securities in a timely manner or at all. It can also refer to a person or entity buying shares or a stake in a company. In psychological terms, a buy-in is the process of someone getting on board with an idea or concept that is not their own but is appealing to them. When an investor fails to deliver the promised securities, they are generally notified with a buy-in notice. The buyer will send notice to exchange officials, who will then notify the original seller of their delivery failure. The stock exchange supports the investor in buying the stocks a second time from another seller. If the original seller fails to answer the buy-in notice, a broker will buy the securities and deliver them on the client's behalf, and the client is required to pay back the broker at a predetermined price. The difference between a traditional and forced buy-in is that in a forced buy-in, shares are repurchased to cover an open short position. A forced buy-in occurs when the original lender of the shares recalls them, or the broker is no longer able to borrow shares for the shorted position. In some cases, an account holder might not be notified before a forced buy-in, and it is the opposite of forced selling or forced liquidation. Securities transactions typically settle in T+2 business days, following the transaction, but some transactions have a settlement of T+1 business day or even on the same day as the trade date. In cases where the securities fail to be delivered, a buy-in will occur. Here are 4 key takeaways. 1. A buy-in refers to the repurchasing of shares by an investor because the original seller failed to deliver the shares as promised. 2. A buy-in can also be an agreement to purchase shares of something, or in some cases to buy a stake in a company that also has other owners. 3. Beyond the financial markets, a buy-in is an act of agreeing with or accepting the terms that someone is offering. 4. In a forced buy-in, shares are repurchased to cover an open short position, as opposed to a traditional buy-in. Hope this would help. Thanks for watching.